Hi, folks. It's Steve. I'm here with Darren Hardison, planner, underwriter, extraordinary man, husband, father, beloved human. Hi,
All
Darren. How are
around.
you today?
Good morning. Doing well.
Good. We're going to continue our discussion about the magic of life insurance. Today, we will focus on what's called universal life insurance, which has received a lot of attention over the last few decades. So, Darren, perhaps you can make it simple for us. What is universal life insurance and why do people like it?
I always start with a conversation, and this is look it up in Investopedia, Google it. So whole life insurance, the original form of life insurance, if you will. I've seen stories. We think like the 1700s. Literally, there's been that version of life insurance. They claim the Romans and ancient Greeks had a version of life insurance to insure crops and cattle and different things. Um, Nonetheless, so whole life insurance, as you know, you're buying guarantees. It's a good policy, um, guaranteed premiums, guaranteed cash values. Most whole life policies are issued by mutual companies that declare dividends, which also can enhance cash value. But it's a very regimented policy. You pay a set premium, um, with some exceptions. Basically for the rest of your life. There's a minimum guaranteed as far as interest rates, and if the company is a good company and they do what they promise they're going to do, um, the policyholders vote and they declare dividends. So fast forward into the 80s, it became prominent. Insurance companies designed and started issuing universal life, basically the next version of whole life, uh, basically because consumers said, hey, we want a little bit more flexibility. What if I want to change my premium? I want to pay more this month or less this month, or skip a month, and I want to be able to make changes and reduce death benefits or increase death benefits or do this, that, or the other thing. And yeah, cash value is interesting. So there's some base guarantee, and there's some assumed interest rate within the policies. So the similarities and the difference, but if I had to say one word, it's flexibility.
Okay, so universal life has flexibility. And you're mentioning there's flexibility in premium, there's flexibility in the survivor benefit. Okay. Um, so 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 is this for all consumers, or is it really just for people using life insurance to protect their family, or as opposed to their business? Do you find there's any differences among the people that are buying these policies, or is it across the board that people are using universal life?
Yeah, I mean, it can be used in any instance that life insurance is the appropriate financial planning tool. One point I didn't stress was both whole life and universal life are permanent insurance, meaning if you purchase a whole life or if you purchase universal life, your objective really is to have coverage for the entire lifetime, meaning I don't know when that day is coming, but when I pass, I want a degree of certainty that my beneficiary is going to get that death benefit. Versus term insurance, usually we're just covering a period of time.
So I can get universal life guaranteed for the rest of my life.
Mhm.
Guaranteed meaning I'll be guaranteed the premium will never go up.
Correct, correct. Yep, both premium and death benefit can be guaranteed.
Well, if I am looking for guarantees,
Mhm.
and both universal life and whole life offer guarantees, um, why would I take universal life over whole life? Is there a difference in cost?
Cost, I can't think of any exception where universal life isn't always going to be more efficient price wise. So lower cost, again, from a consumer's perspective, I think whole life is interesting. I think I like the guarantees, but if I can accomplish the same or a very similar strategy with something that costs significantly less and gives me the flexibility to make changes as I have changes in my life, that's why we see percentage wise, we sell much more universal life than we do whole life. Steve, I mean, this, we'll get inquiries from existing clients or prospects, and they say, hey, I want insurance. I don't want term insurance. I want something I know is going to be there and I don't have to worry about it. Can you quote me whole life? 9 times out of 10, they don't really mean whole life. That's just the language that they know. What they're saying is permanent insurance. So I'll show them both head to head, and they're like, oh, well, I think I want universal life.
I get
And
that.
we're not knocking whole life. There are situations where it makes sense. But again, the universal life is kind of the, was the new fancy, thing, at least, back in the 80s. And it's continued to evolve, and there's multiple different versions of universal life today, which we could spend separate segments on. You know,
So with the if both whole life and universal life are offering guarantees,
mhm.
but universal life is cheaper, what's my trade-off? What would a whole life product give me that a universal life product wouldn't in terms of guarantees?
Excuse me. Yeah. So again, the what appeals to whole life, appeals to people, is it's more purely guaranteed. So the guaranteed interest rates built into a whole life are higher. We know historically mutual companies always, pay their declared dividend rate. So they're comforted knowing what I see illustrated when I purchase a policy. This is how this policy is likely to perform. I know I'm paying more for it compared to universal life. I'd rather have that peace of mind knowing it's quote fully guaranteed, versus the universal life has some underlying assumptions. There's a modest guaranteed interest rate, and then the company assumes a higher rate. That's the rate that they think they'll be able to credit on an annual basis. But it's also subject to market and economic conditions as well. I mean, we're in a very high interest rate right now after spending basically 10 years in a zero interest rate environment. So what we're seeing companies do now on universal lives is they're actually increasing their crediting rates. So people that bought universal life 10 years ago, their policies are actually starting to perform even better than when they were first issued, versus in the 80s, as we've discussed before, where interest rates were sky high, and then as interest rates became very low, some people who had very old whole life policies, their policies started to perform worse.
All right, so that's interesting. So you're stressing that if somebody's really oriented towards large amounts of guaranteed cash accumulation, then the universal life product is probably not for them. But if they're interested in guarantees on the premium and guarantees on the death benefit, for a lower price than whole life, then universal life is for them. Okay.
Yep.
So having said that, why would somebody want lifelong coverage?
Basically just they have an established need. Maybe it's for estate planning, charitable, or just due to the fact they don't want to have to worry about purchasing insurance again in 20 years if their insurability changes, medical status changes. If I'm 40 years old and I buy a 25-year term because I'm only worried about getting through retirement, the purpose of insurance, is to protect my income. But oh, I forgot, once I get into retirement, my insurance needs change. Maybe I need some other, or my spouse or my trust needs some other source of liquidity when I pass, so we don't have to sell investments, sell real estate, what have you. If I would have purchased that when I'm in my 40s, I would have paid a fraction of the cost and still been able to guarantee that through, my lifetime.
So if I foresee a need for liquidity, estate liquidity going forward, then it's a more cost effectively priced product for me. Okay, tell us about, you hear a lot about features, additional coverages that come with life insurance. What kind of additional coverages and features and riders would be available with Universal Life?
The probably the most popular variation of Universal Life right now is basically the same type of chassis, but what companies have done is said, look, a lot of people just want permanent death benefit. They don't necessarily care about cash accumulation. It's interesting for certain people, maybe it makes sense. For another session, we're going to talk about index universal life, which is the mechanism that people use to accumulate cash inside universal life policies. I won't spoil that conversation. But yeah, there was a huge need just for people to say, I want permanent coverage, but that's it. You and I call it permanent term insurance, meaning I want to pay the very minimum for the cost of insurance. I want to guarantee that $1 million death benefit. I've got longevity and crazy genetics in my family. Aunt Bessie lived to 112. I want this guaranteed for my entire lifetime, but I don't want to pay more than I have to. So they issue what they call guaranteed universal life or guaranteed death benefit products. And it's truly that you're paying a premium. It's still flexible. We can say, well, when I turn 80, I don't want to have to worry about paying premiums anymore. So we structure it to where we pay premiums to age 80, or I want to pay premiums 10 years and be done with it. Again, if something happens, I can call the company, we can make adjustments, change premium schedules. And it literally is a piece that fits right inside the financial plan. And with certainty, whether I die prematurely or, crazy, 120, I know that death benefit is going to be paid to the beneficiary. As far as extras you'd asked, again, companies always coming up with cool things. A neat trend probably in the last at least 5 years is the long-term care rider or chronic illness rider, where that $1 million policy, you die, the $1 million goes to the beneficiary. However, if you develop a chronic illness during your lifetime, you can actually accelerate that $1 million to use to offset long-term care costs. So a lot of folks are saying, well, it seems more efficient. I don't know that I'm going to need long-term care. I know I'm going to die someday, but what if I could consolidate those two in one way or the other? I'm using that either during my lifetime or, my spouse is getting it when I'm gone.
That's interesting. So we have on the one hand, a guaranteed benefit to last as long as I do, but at the same time, if due to life circumstances, I need money for things like long-term care, I can sacrifice some of the death benefits. So you're saying that, let's just suppose I have $1 million policy and I have $500,000 of care expenses. I can take 500 off the death benefit and then leave my survivors the other 500. Is that how that works?
Yeah, absolutely. And what's cool, so again, some of the better products will actually have what they call a indemnity style long-term care rider, which means once you qualify, we send a certification, you get your doctor to certify that you can't complete your 2 out of 6 activities of daily living, which is a standard pre-qualification for any form of long-term care. As soon as the insurance company gets that letter, Usually there's like a 60 to 90-day waiting period, which is common in long-term care insurance. They'll start paying you a monthly benefit from the insurance policy, and you're not required to use it for healthcare as long as you qualify. Indemnity style means that you're not providing receipts or proof of skilled care. Again, so the family, your spouse might be taking care of you, or a loved one or a friend, so it doesn't have to be a skilled person, or you're using the money for something entirely different. So it's just a nice added feature. And then the other thing I was going to mention, a couple of the guaranteed death benefit products that we like, I call them exit strategies. So in certain years, usually it's year 20, 25, 30, in that range, the company will give you an option. Your circumstances have changed. You don't need the policy. They'll refund. Usually it's like 50% of the premiums you paid in year 20. Excuse me. And then maybe year 25 or 30, they give you an option to walk away with 100% of the premiums you've paid into it. Again, from an insurance company's perspective, I have to believe that they don't believe, at that point, someone is going to want to walk away from the policy. But it's pretty cool to have, that option, and it's a good selling point from our perspective as advisors, and say, if something changes, again, the whole nature, that's why I started with flexibility. The whole nature of universal life is flexibility. What if life changes? Usually does. We don't know when and don't know how.
That's very interesting. So on the one hand, I can have lifelong coverage on a guaranteed basis. At the same time, if there's a health crisis, I can use the policy to pay for the cost of care. In addition, after a certain amount of time, I can just say I don't need the life insurance any longer for either survivors or for current care, and I could just get my money back. I can't think of anything that's more flexible than that, to tell you the truth.
Yeah. So, what is a circumstance, a possible circumstance? My spouse predeceased me, and maybe when my wife passed, I put everything else in trust. So when I'm gone, everything is going to be distributed according to the language inside the trust, and or this or that or the other thing. There's really no purpose, to have that, death benefit payment anymore. Again, it's an option.
Good. All right. You alluded to Index Universal Life, which, as you say, we are going to cover in another program.
Mm-hmm.
Are there any last comments you want to make about the guarantee-oriented product that we've been discussing today?
When I'm talking to a client, I'll, talk about this as well. I'm usually using the term leverage. Well, what am I talking about? At the end of the day, it's how much does this cost me versus what is the ultimate benefit? So, we always preach our pre-qualification process, which is underwriting, and underwriting, drives the classification, which drives the pricing. So in essence, how much is this insurance policy going to cost me cumulatively over the years versus, again, we don't know when we're going to pass, but if I live plus or minus to life expectancy, I'm paying this much in premium. I know my estate / beneficiary is getting this much in death benefit guaranteed. Based on that math, it's financial planning. It is what it is. I mean, it makes sense or it doesn't make sense. And some people
I get that. So you're saying that the lifetime guarantee, you keep that policy in force, the survivor is going to get paid, and the amount of money that they get is this much, and the amount of money you paid is this much. and
Mhm.
therefore it's a good deal. That's the leverage that you're describing, right?
Yeah, yeah, and so and a lot of people have, strong convictions either way. Oh, my family, no one lives past, 68, or everybody lives to 92 in my family. So chances are, and again, nobody knows, but it gives somebody kind of a benchmark and how to plan. But at the end of the day, the purpose of insurance is to protect against an unknown, you know.
Well said from a life insurance pro. All right, Darren, very good. Thank you. You've given us a good overview of universal life, and you've helped set the stage for our next conversation, which will discuss the cash component
Mhm.
and how the index products work. Thank you very much. Look forward to that conversation very much. And thank you, everyone, for joining us. See you then.
Good stuff.